Understanding sequence of return risks. This is a big deal. Everyone knows about this, generally speaking, that if you get hit in the first year of your retirement, you could be in a world of hurt. Everyone kind of conceptually grasps that, but there's so much more. And I want to dive into that because I've been hearing a lot about this lately, especially with we're in correction territory now, and I'm not sure about the S&P 500, but certainly NASDAQ. Correction territory means you're just down 10%. This happens all the time. I mean, the average correction on any given year is 14%. So, it happens all the time. But when markets go down 10%, people had $1 million, now they got $900,000. People get antsy. That's just a fact. So, remember, the markets are so good at predicting 6 months from now. So I'm telling you, the recession is 6 months from now. We just see it right now. The market is predicting this for sure. And I wonder actually, let's take a look. Let's look at, I want to show you something here. Hold a sec. So here's VTI. It's up 9.19% so far this year, but you can see right there, $10,000 went up to 20%. So it's gone from 12 down to 1019. So let's take a look what that would be. So we're going to make, this is as of today, right? What's this as of, where's the date on this guy? Looks like as of yesterday, it looks like 1025 there. Anyway, so we're just going to run with it. We're going to say, so 12, so actually what's that? 200, we're going to go 12,000 minus 10,919 equals that divided by 12,000. I don't think it's quite in correction, about 8%, about 9%. So we're not quite in correction. No, that's right there as of October 26th. All right, so we're about 9% down so far. We're not quite in correction territory yet. But anyway, so the point being is the markets are so good at calling 6 months. I'm just telling you, it's amazing, frankly, how good these guys are. So the markets go down X amount of time. That means they're predicting that in 6 months' time, we'll be in a recession, or 6 months' time, we're going to be in a growth category, something like that. So, I mean, you think about it, it's crazy. Look, we just got GDP numbers in today. And the GDP numbers, look, everyone and their mom was calling recession basically first, second, third quarter, and we haven't had any of that. It's crazy. I mean, who cares? Look, the government numbers are the government numbers. We just roll with it. And we see what a 20% increase from the beginning of the year until basically, what was that? I don't even know what that is. September 1st, I guess. We had a 20% increase, which meant the markets were calling significant upside of the economy from right here to basically right here. So Q4 will probably be a growth-oriented Q4 because that's going to be residual from this right here from 6 months previous to Q4. And then the Q1 and Q2 will probably be back. Q2 is probably Q2 of 2024 will probably be quite bad. It's amazing how that works, actually. I don't know. I've already used 3 minutes of my allotted time here, so I want to keep to the point here. But anyway, so I want to show you something here. And Michael Kitts, this guy's just a freaking legend. He's got 3 kids. Maybe he's got 4 now. The guy, he lost some weight in this picture. I hope he's kept it off. He was a heavier guy, as I was, and he lost some weight. Hope he's kept it off. But this is dated in 2014. One of the best articles on sequence of return risk there is at kitses.com. I'll put a link in the show notes. So we're just right here. We're going to go to the mathematically, the sequence of return doesn't matter when there are no cash flows in or out of a portfolio, even when there's extreme volatility. For instance, $1 million portfolio that experiences returns of negative 50% and positive 100% finishes with the same balance as a portfolio that has returns of up 100% and down 50%. All right? So if you take $1 million, you're down 50%, you're down to $500,000. And then you add 100% rate of return, you're back to $1 million. After 2 years, you're back to $1 million. You add $1 million, you add 100% rate of return, so your $1 million goes to $2 million, and then you're down 50%, so it goes back to $1 million. It's the exact same thing. It's the cash flows, i.e. retiring, that determines everything. All right? Once cash flows occurs, the differences are different. In the logical extreme, imagine a retiree with $1 million who needs to take out $500,000 at the end of the first year. With the good sequence, the portfolio grows 100%. So it grows from $1 million to $2 million, which easily funds the $500,000 withdrawal. He's still got $1.5 million at the end of the sequence here. And after a 50% drop, he's now still got $750,000. So he went from $1 million to $2 million. He took $500,000 out. The portfolio fell by 50%. He still has $750,000. By contrast, with a bad sequence, the portfolio falls 50% in the first year. It goes from 1 million to 500,000, and now he pulls the 500,000 out. He's had a big fat goose egg. That's the sequence of return risk. Of course, in the real world, retiree cash flow needs are not nearly as extreme as needing to spend half the portfolio during the first year. Nonetheless, the fundamental point remains. Once cash flows are occurring, i.e. outflows without question, it's not enough for returns to average out in the long run. I was just talking to a lady today from California, IA. And she's like, look, I don't expect an average of 10% rate of return at all. I said, 100%. I think that's silly because the average 10% rate of return, historical standards, means nothing when you're pulling money out. It doesn't mean anything. It's silly. So I suggested, because I can't tell people what to do, that she makes her portfolios a lot more conservative because she's getting ready to hang up the boots. And as such, we got to protect a massive decline in the first year or two. All right. So let's see right here. He's using a 60-40 portfolio, 60 stocks, 40% bonds. He goes, while the safe withdrawal rate research has brought a great deal of visibility to sequence of return risk, the caveat is that when spending needs are modest, 4% a year or whatever, the consequences of an early bear market are not necessarily all that severe. After all, diversified portfolio, 60-40, a bear market crash in stocks might simply mean the first year liquidation comes from the bonds, as I talked about my barbell. You got, in this case, you got $1 million, 600,000 in stocks, 400,000 in bonds. The market gets killed. The stock market gets killed. You take it from bonds. All right. That inherently that makes sense. If the portfolio bounces back in the subsequent year, not a single dollar of stocks would have been liquidated while they're down at all. Accordingly, the first year, again, he just talked about if stocks get hammered and you have a 60-40 portfolio, you take it from bonds. As the results reveal, there's not a terribly strong relationship between the safe withdrawal rate and just the first year's rate of return. The worst return, minus 42%, is associated with a lower safe withdrawal rate, but it's still an average rate of a safe withdrawal rate of 5.34%, well above the 4% threshold. And similarly, withdrawal rates of 5 to 6% are found on the opposite side right here, where the first year's returns were 35 and 55%. Basically, it almost doesn't really matter as long as you're not taking a huge amount of the first year of your portfolio if your portfolio is diversified historically. I'm going to share with you the caveat here about the safe withdrawal thing. As noted earlier, the reason the safe withdrawal rate has little relationship to just the first year withdrawal is that in the short term, a diversified portfolio has other sources to draw from. All right? You can take from bonds when the stocks are down. You can take from stocks when bonds are down. The true risk is not nearly a bad return in the first year, but a string of bad returns where the cumulative withdrawals add up to something more significant and the portfolio in the aggregate starts to get winnowed down, i.e. that just inherently makes sense. You're like, man, I'm getting crushed everywhere, but I'm still pulling the money out. And this is what happened. This was written in 2014, before what happened in 2020. All right, so I want to show you what happened in 2020. And 2022, excuse me. So we're going to show you something here. The total bond index from Vanguard, BND, Band-Aid. So we're down 2% in 2021, 13% in 2022. Look at that, 2 and 13, another 3% so far this year. All right. So in 2022, this was down the worst it's ever been. Nothing's ever come close. All right. Now on top of that, let's look at BTI. All right, we're going to look at BTI and show you what that sucker did in 2021, 2022. In 2022 in particular, so we're going to go to performance, and I'm just looking at the dogs, and you can see this guy was down 19% in 2022. All right, so it was up nice, it was down 19%. So in 2022, we had the worst bear market in bonds we've ever had, on top of a bear market in stocks. So if you're in a 60-40 portfolio, where was the reprieve? There wasn't any. You were saying my bonds are down 13%, my stocks are down 20%. And so if you're taking 4%, 5%, you didn't have any recourse there in terms of where to pull from that wasn't getting smoked. It just wasn't. And on top of that, now, thankfully the stocks came back strong so far this year, but now we're in a little bit of a correction mode. The bonds are still down. And I want to show you something. Check this out. That has never happened before. So this is the Putnam Income Fund. We don't have a lot of bond funds that go back that far. I think Fidelity has one. I think Putnam, a couple other ones. But I like the Putnam one. And you can see in 1973 and 1974, right here, 73 is only down about 10% total, not even 10%. And 73 and 74. This is when the market as a whole was getting hammered. Right, the stock market was down like 44%. So we've never had the sequence of return risks the way we had in 2022, where we had we had 73 and 74, but never anything like that. Last year was the worst, man, by far. Nothing came close. The BND was down twice more than what the Putnam Income Fund was down in 1974. It's crazy. On top of that, BND was down in 2021, 2022, and so far this year in 2023. We've never seen that. It's crazy. On top of that, the stocks are down, bear market territory as well in stocks. So we had a bear market in stocks in 73, 74 is down in the aggregate about 44%, and bonds are down roughly 10%. And then, but we literally have never had this. And the next year, bonds, look at that, 17 and 20%. That's why I'm big on bonds right here, because if you look, down, down, up, up. I mean, look, every down, look at this. Down, up, up, down, up, 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 down, down, up, up. I mean, it's the same old story. Bonds down, up, every single down. Look at that. Now, I can't guarantee anything. I don't know. But we've had the worst bond market in history. What does that do for your bonds? Well, it's hard to imagine they don't come back up. I don't know. Anything could happen. Let's keep going back to Kiss is what he says here. 2, extremely bad results are clearly associated with the lower end of the withdrawal rates. And the high subset of returns are consistently led to moderately higher withdrawal rates. All right, so basically going on a 10-year stringing, almost like Japan, going back to 1993. I think it was 93. I can't remember. Japan had a 20-year bear market, essentially. You know what I'm saying? And so now we got a 30-year run. To some extent, this simply reiterates the importance of sequence of return risk. Long-term returns over 30 years don't matter if the returns are so bad in the first decade that the retiree runs out of money before the good returns show up at the end. The point is, I cannot stress this enough. Growing your portfolio as you go into retirement is a young man's game. We don't need to grow anymore. I mean, we should try to get some growth. Growth is not the priority anymore in retirement. Protection is the priority. And now you're getting 5% in a money market account, 5% in short term, 5% in freaking zero coupons. There's no reason at all as you're transitioning to retirement to be taking growth risk. I mean, look, you should have some, like the lady I was talking to today. We have a 3-bucket portfolio. Husband's got cash, VUSXX or the Vanguard Federal Money Market Account. I don't think VUSXX and I forgot what it was. So it's 5.3, something like that. So he's got cash there. She's got the 2025. So IRA, his is in money market. Hers is in 2025 fund. All right, so her IRA is 2025, Vanguard Target 2025. His is in money market. Over here in their brokerage account, they got total bond index, total stock. He's got a big old piece of firewood in his mouth, and he runs off to... Oh, doggies, I love you so much. Does the talk about dogs make you mad? You don't want to hear about dogs? What does some guy say? What did he say on this? About, it's not very professional to keep talking about dogs. What did he say? I don't find it. But he said something like, you don't have to talk about dogs, It makes the videos longer. It's not very professional. It's like, oh, man. His time is very valuable, this guy. I said, your time is so valuable that you took some of your valuable time to post a stupid comment. Look at that, dude. You're telling me that's not worth the price of admission? Look at that guy. Look at those eyes. That's worth the price of admission. Anyway, so hold on a second. This lady was very down on herself. She goes, I didn't invest very well. She's an accountant by trade. She owns her own business. I said, sister, you're fine. However you got there, by hook or by crook, you got there. And so what happens is we have a 3-bucket portfolio. We have the husband's money market and his IRA. Her IRA is in the Vanguard 2025 fund. And then they got a brokerage account that's in Wellington. It's in total bond index and total stock index. The bulk is in Wellington and total stock index. And that's a brokerage account. Very limited dividends in there. A little bit in the Wellington, but hardly any capital gains. Again, a little bit in the Wellington, but not any from the ETFs. Probably getting 8,000 a year in income, maybe 10,000, something like that, but not much. And it's all qualified, preferable. QDIs and LTCGs, so long-term capital gains and qualified dividend income. So not a big tax hit there. Anyway, so I'm saying, so basically they need about 50 to 60,000 a year from their portfolio until he gets on Social Security. All right, so I said, man, so what you should do is you basically have the 2-bucket approach here for your IRAs. We want to leave that post-tax account for later. Let that sucker grow and grow. because a transfer upon death would step up in basis, limited taxable hits. We want to exhaust your IRAs. You know, we don't literally want to exhaust. We'd like to have it, but as we're waiting for Social Security to kick in for this guy, Jim Bob, you know what I'm saying? We're going to say, Jim Bob, just tap it. So Jim Bob and Ann, I don't know, Jim Bob and Ann would say, if the 2025 fund is up and we need 60,000 from the portfolio, take it from the 2025 fund. If the 2025 fund is down and take it from Jim Bob's money market account. We're going to pretend the brokerage account doesn't exist. Why? Because that's the money we're going to live on once he's on Social Security, and we have minimal distribution needs from the portfolio anymore. Even if the IRA is exhausted, even if you get no growth, you only had once he's on Social Security, they just don't need that much from the portfolio anymore. But they need 60 to 70,000. Even a couple of years they need more because they're helping their daughter out with wedding and whatnot. I said, take it from the IRA first. So we got the epitome of a 2-bucket portfolio, the barbell. But there's a third bucket over here called brokerage account, which is freaking fantastic. She goes, you think I did okay? Yes, come on, give yourself a break. And she's throwing the kitchen sink at her distribution amounts too. I said, no, you're going to be just fine. Like in terms of her expenditures, I said, you're not going to spend all this until you're dead. It's just silly. But anyway, you know, she wanted to make sure she's good to go. I said, yeah, absolutely, you're fine. The point being is, this is how you avoid the sequence of return, especially with money market accounts right now paying 5.25%. You know what I'm saying? Look, the bond market is the best bond market we've seen in my whole career. The money market is the best money market we've seen in my whole career. Stocks are, who knows? Are they bad, good? I don't know. Will they be better 10 years from now? Probably. But they're only going to be better from 10 years from now if you have money that you don't need to touch. The money's got to last, like Kits has talked about. If you had all your money in stocks and you're down 50% and you need to take a 50% distribution, you ran out of money. We need your stocks to grow, which means we need your portfolio to grow, which means we have to have a portion of your portfolio you don't touch. That's why we avoid the sequence of return risk. It's just that simple. We don't need the growth anymore. We need the protection. Hope this helps. Love to hear your thoughts. Don't forget to sign from email list and Doobie Duke. Retirement planning course is still available. It's still, I'm not going to drop the price. It's $250. It's still worth it, man. And again, if you take it for 30 days, you don't like it, friggin' get a refund. I don't care. You know what I'm saying? But after day 31, I'm not going to give you a refund. You can take it. Just $250, dude. It's the best retirement planning course, in my humble opinion, in this guy's opinion. Don't you want to help Pablo? Actually, he lost a tooth. Look at this guy. He's got his meth teeth. Look at those teeth. Oh, I'm not going to show it, but see, look at that. Toothless. Are you taking meth? You and Finney taking meth at night? They sleep in the same crate. And one of these, look at that, dude. That is a sign of a white trash dog if I've ever seen one. All right, love to hear your thoughts. We'll see you.